Just double check that all the audio is as it should be, and I think it is perfect. All right, brilliant. So today we'll be doing yet another stream, another use case, and this is a particularly exciting one. Specifically, we're going to be looking at how to do decision making under uncertainty in venture capital. And what that really entails is that we need to figure out how we want to decide on ways that we can best utilize our funds and allocate our resources as we invest in different potential startups. And what we want to do is to use existing startup data and observations within our portfolio, as well as potentially external information from the web. So let's say some aggregated data about what it's like to invest in various different startups, how different categories of startups might perform a priori, so without knowing much else about them other than that they are perhaps a few years old, etc., but not knowing anything about their particular sales performance or other key metric performances. And of course, we want to look at potentially existing, let's say maybe failed investments, as well as then looking at whether or not new investments should be joining our portfolio, whether we want to actually spend the money to invest in them. And we'll go through all the different particularities of this problem here in a second, but I think this is going to be a lot of fun. We will, as we go through this might not be finished just today. It might take a little bit longer as we go through this, because I have not prepared this at all. So we'll be doing this together. Besides what I have done is I have sort of prefaced everything with the overall task and the definition of the problem, but I have not actually written or built any sort of model yet within Excel that we can use to make these decisions. But with that said, let's dive into it. And also another thing I noticed the last time I did one of these streams and recorded how we built these models is that it turns out I am not particularly good at remembering to zoom. So I've tried to prepare everything now so that the spreadsheet is zoomed in already. But in case I forget at some point, do remind me, either in the comments or if you're on YouTube or in the chat if you're coming in at a later time. And I should also remember to highlight the mouse here, which we have done. So let's see if I put it on the screen. Indeed, look at that. The mouse is highlighted. That is perfect. So we can actually see what I'm looking at. And we'll actually also, I don't know if you knew this, but if you're on Windows, the Power Toys app allows you to set up these highlights for a mouse. So you can see when I click, left click, it leaves a mark. And if I right click, it's a black mark. Well, that was hard to see because it came with the options there. But that is going to be hopefully much easier to keep track of what I'm doing. I hope. Anyway. Okay. So let's take a look at what we're going for here. You don't need to see my water bottle. That is not particularly interesting. Just move that over there. There we go. All right. So, starting from the beginning, it's all about adaptive decision making under uncertainty, because not only do we want to decide how we want to invest currently, but we want to also keep track of our portfolio as we progress through time. So if we start to see an indicator that a portfolio company is not performing the way that we expect it to, we might want to reassess how we invest our money. Maybe we want to try to mitigate our losses, or maybe we need to consider whether or not more money should be injected earlier than otherwise planned to try to make up for any sort of discrepancy, potentially. And we also want the system here to be able to continuously use new joined startups to the portfolio and their performance metric to better reason about, yet again, new potential prospective startups that we might want to invest in later. So that is all just to say that this is, again, decision making. There's a lot of uncertainty all over the place here, very much so, especially when we think about startups. But we want these models or uncertainties to adapt dynamically and continuously as we allocate more and more information and data and observations. So that's what we mean by adaptive decision making under uncertainty. And before we get into sort of the point of entry, we will focus here firstly on the left a bit more as we go through the different problems and considerations. So perhaps I will actually zoom a little bit more as we go through this. That might not be the worst idea. There we go. Okay, perfect. So as we know, the purpose of a VC is, of course, to maximize the returns to their limited partners. That is the long and short of it. There's not much more glorified about venture capital. Sure, they might have various different kinds of philosophies and particular ways they want to invest their money to support certain endeavors, such as, let's say, environmental startups. So for startups that might focus on bringing to the world various different technologies that could help improve our environment, or it could be clean energy, it could be fintech or whatever. So different, but besides that, either way, the limited partners provide money to the fund that's available to be invested by a venture capital, and they are not going to be very happy unless they make a return on that investment. So we at least have to try and beat the stock market, say, if we were to follow any kind of Fortune 500 index, for example. But that's long and short of it. So what those metrics are and what the limited partners need is a sort of goal that is particularly provided and given to any particular VC, and how much money that VC has available to be invested over, let's say, a period of time is also unique, potentially anyway, to each VC. So those are all considerations we'll have to think about as we go through this use case. Now, one of the things that's worth considering for a VC is any investment is allocated a reserve. And basically what that means is that in the future, an investment that we make might need another investment to continue to scale and grow. So this could be for whatever reason. It might be that we are building something that's highly technical, and so there is a long development period, let's say a year or 2 years, and so the initial funds are raised such as to make possible that development. Alternatively, it could also be that the development of the product is essentially done and sales have started, and we're continuing, and this particular startup has continued to build out its go-to-market strategy, etc. And now further down the line, once they have validated a sales strategy, they want to raise money so that they can scale up the sales strategy and really expand into the market and start to acquire more of the market. So acquire a bigger market share. So if we were to label the investment size, any kind of investment, as X, we could consider the reserve that we anticipate we would need. So basically, we would allocate a fraction of the funds to such follow-on future investments. So we don't want to lose that money. So because we want to have it such that if and when any of our existing portfolio companies would need more funding, we might be able to have money available to essentially also save them. So if there's a certain chance that they might start to go bankrupt sooner than they anticipated, that's another reason why having money in reserve to protect that investment is potentially a good idea. So that's what we consider reserves. And we need to here consider what any potential future round might be at, and we might get a price at a certain pro rata rate, which we can call Z. We may or may not use that today, but it's another thing we would actually want to consider. Investment. And you can also see I managed to misspell this. This is obviously not an investment. It is an investment. Perfect. And there could be more rounds than just one. It could be you might invest at a pre-seed or seed and consider follow-on at series A, B, and C, etc. And every round will be at different sizes and so on. So this is a quite highly constrained problem already, as we can imagine. There's a lot of things to consider. How long does it take until we need the next investment for all of our portfolio companies? How much money do we have available? How much money do we need in reserve? How do you want to change all of that given the performance metrics of all of our investments and the portfolios, including those that didn't succeed and might have closed down since we started? We'll probably have failed investments as well. And given all those constraints, how much is available to us to make other investment into new companies as well? And how do we make the trade-off between potentially cutting down on our reserve, which we may not need right now, given that there might be really good opportunity coming along that's worth the risk trade-off between gambling a bit on whether or not we quite need such a big amount in reserve. So we'll get to that later on, but those are some of the considerations that we will consider. And it should be pretty obvious at this point that these are not trivial considerations. And one way we can at least quantify this fairly easily, for now ignoring some of the other constraints, is just that any new investment we make, or it could be more than that, what we need to be sure is that the total amount of money needed to make the investment, which is now X, the money that is being asked for, plus what we would assume is the needed reserve for future follow-on investments, it has to be, of course, less than the total fund size minus any existing investments we've made and required reserves that we've also allocated to those investments. This is just a simple constraint that we might want to consider here. Now, I think I've also prepared this, forgot a couple of other things we might want to consider. Let's see here. That is for further down the line. So the decision that we essentially would want to consider here is whether or not a new and otherwise promising investment should be made. So even if we like the potential company that comes along, we may not have the funds available. And so another way of framing this is to say, what is the impact, or multiple impacts would be more. So what that would be, what are that is, let's just do the singular, probably sounds better. What is the impact on future expected returns when deciding between different possibilities? That is the crux of the matter, because this is what we're trying to optimize in the end. And the only thing we can do is to allocate resources and make that money work for us, well, by proxy, through the startups doing the work. But that is the problem. And this is not a trivial problem. And in fact, it is probably one of the hardest problems due to all of the uncertainties we would have to consider. And there are loads of them. And before we start thinking about the model, we will finish some of the problems we would have to consider. But I should also mention, probably at this point, and I'll try to do this more than once as we go through this model, is that the very nature of how a VC would operate and the market and the industries that they care about and what they want to invest in will make these uncertainties quite different. There may be a different number of them. They may be looking quite different from one VC to another. And how you might want to model it out depends on the particular analysts and investments researchers and the particular partner, general partner, VP, etc. within the VC, and the things they care about, particular metrics that they care about, and the approach and philosophy that they operate with or under. And so the sheet that I'm making, since I'm also not in VC myself, I'm not an investor, in fact I run a startup, but my sheet will look probably somewhat different. But the point here is that it doesn't matter how the model itself is essentially built up. The fundamental problem that we would have to consider and solve are agnostic to the particularities of how different uncertainties are defined and how they all connect together, etc. We'll see kind of what that looks like, but the point is that this is just one example of what one could do, but there are many other many other ways that one could go about building out the analytical framework that we'll be using. Point is, there's a lot of freedom. So let's first of all touch upon some of the main issues we might want to consider that's done now. So why we go about doing this with the Evara system and why these are difficult to actually solve without it. So the first one is, immediately, we don't know if an investment is going to turn up profitable, and we don't know by how much. So you can imagine if we knew if a particular investment was going to be profitable in the end, all we would really care about is trying to decide whether or not, let's say, and I actually also have this here available towards here so I can actually draw. So zoom in here. So you can imagine if we have, let's say, startup here, A, and startup B. Now, if we have a pot of gold or some money, now I really get to use my drawing skills here. So if you have some money, what we have to choose is whether or not we place them in A or in B. And I can see here that my it's not perfectly synced, but that is okay. It's still not perfectly synced. I suppose that is. I see. I understand. So this is actually due to the fact that the iPad I'm drawing on is not exactly perfectly aligned, and so it can mismatch these lines ever so slightly. So anyway, these are the things we would have to consider. And I even drew a question mark, which is also gone, so I'll remove that here and just show it like this. So this is the question. We'd have to decide if we go to spend our money in, we can see here, over in B, or if we spend the money over here in, look at that. At least I can actually do this. So that we can act, I guess I shouldn't be doing it too much. Aha, there we go. Right. So if we were to decide to spend our money in one of them, and we know both of them are going to bring back some money, so if we consider this essentially if we push this through a machine, a money generating machine, essentially like an oracle, we know what's going to happen if we place this money bag into one of the two. What is going to come out through this machine that we have. I'm curious to see if this is actually going to work. I think it might be. And this here is supposed to be a cog. You can kind of imagine that it is. Now, if we know that you're going to have a bigger bag here in A, like so, but over here on the right, we might have a much bigger bag. Like this. And assuming that's the case, then what we would want to choose, right, if this is B, so actually it turned out to be not the easiest thing here. But if we were to put this money in one or the other, this would give us this. So A, still don't know what we would choose. So A gives us a smaller amount of money, while B gives us a much bigger, larger amount of money. Assuming we make the investment the way that we've just discussed here. Now, here we go. Perfect. That is actually brilliant. So this thing is having a rough time. So anyway, the point here is that if we know that both of them are profitable, all we would really need to worry about is which one of them gives us the most money back. Now it gets a little bit more complicated in that some of them might not be profitable, which means you might lose money. So some of the money might just fall into a big gaping hole that we will never recover from, given that investment. And in fact, this is very much one of the things that you need to consider, and we'll get back to that. Namely that there's a hit rate that we would have to consider for a VC, which is, given the investments that are made, how many of them are actually going to turn profitable. So this is where a lot of the risk starts to come into play that we'll also need to consider. So these are some of the trade-offs that we'll start to play around with eventually. Okay, I'm just going to check here that there are no missed messages. Okay. It just looked a little bit weird here. All right. Not a problem. Brilliant. Okay. So I'm gonna jump back into it here. So we'll get back in a second, but those are some considerations, and those considerations that we'll be looking at are going to be success rates or hit rates, and they'll be part of driving our model and our predictions. So the next thing we would consider is that one of the other problems that a VC would have to consider is there's an uncertainty about when and if new and existing investments need additional funding. So this is what we talked about earlier. And again, if so, how much is needed? So there might be a plan to begin with, but we all know plans never hold. So the question is, how much will we deviate from that plan? Another uncertainty. And there might be further uncertainties that are a bit more abstract, namely whether or not we as a VC might need to lead that round, even though we may not want to, because it comes with other certain obligations and responsibilities, essentially, either concretely or at least in terms of reputation, where other VCs might look towards us as doing our, what's that called? Due diligence as well. And now there's the question of, are there potentially a conflict of interest, etc., because we've already been investing, so that might undermine a bit the lead position in the future. Something to think about, at least. And thirdly, we also briefly touched on this already, is that VCs don't know the real reserve that is needed. So again, we would have to always make these estimates. And it matters when we're trying to plan out, especially as we near the more end of the period where the funds are available to us. Because there's a limited amount of money. We can't just ask for more and more money. There is only so much money we're allowed to invest. And since we don't know what the reserve needs are, that poses a completely different problem about missed opportunities. In particular, the money that we have hold in reserve could otherwise generate large returns. We could invest them in other businesses. But if we never end up using them, simply because we keep them around for reserve reasons, then they are just needlessly essentially depreciating in value since there's inflation. But maybe not the biggest concern here, but still, it is perhaps not minor. Right? There is actually going to be some millions of dollars that are going to be lost due to inflation. So if inflation is about 2% and it's pretty easy, right? So if you're in, let's say here, so if right, so let's say if we have $1 million, or 100 million rather, supposedly. Wow, it's really not well aligned, is it? Suppose we've got $1 million in our fund, but then let's say inflation, how much value is lost. Wow, that also really jumps down there. I need to see if I can figure out the proper alignment of these, because it's not really that easy. But if we have a 1% inflation, what that means, perfect, is that we'll lose $1 million just due to inflation. Right? So there we go. Perfect. So that's obviously quite impactful. Right? It's not that trivial to say that we can't not worry about inflation, because the fund diminishes essentially, since we won't account for the inflation over time. So we actually want to get our money to work as fast as possible as well. But that's another trade-off that we need to consider. So you don't want to be rushed either. Perfect. All right. And finally, we don't know if another or potentially better investment opportunity presents itself. later. That's another important consideration and another unknown. It's another uncertainty. But these are all known unknowns. We know about all these uncertainties. And then there's all these uncertainties about timing. When would we need to raise another round, etc. So VCs are dealing with so many uncertainties that it's almost ridiculous. And the problem is, in particular, that the amount of data available is vanishingly small compared to how we would otherwise think about either statistical or AI approaches to this sort of problem. So you can imagine if we had one startup and want to see how it performs, we would need some sort of system that has been trained on a massive amounts of data, ideally for this particular startup, about its performance, so we can make better extrapolations into the future using machine learning and other AI-like systems. The problem is there is no such data. We basically only have data for, at best, essentially, if we use a more traditional approach and go bottoms up to evaluate the business and its performance. We might look at sales on a monthly cadence. So that means you only have, at best, 12 sales data points in a year. So 12 times number of years in operation. And that's assuming there are sales for all the months. And that is a horrible place to be with very, very few data points to try to infer any sort of real signal that is not going to be subject to large overfitting. So that is a known problem within machine learning and those AI systems. So that is one of the main reasons this is very difficult to actually do with those kind of systems. And that is why we have to resort to, and rightfully so, to more intuition and educated guesses. So a general partner or research analyst in a VC will utilize their expert knowledge and the human intuition and that kind of logic, which is not completely random, but there's a lot of uncertainties that are made that are based on expertise that drives all of these uncertainties. And then the general partner will talk together, and ultimately there is a gut feeling that is going to drive whether or not this seems to be a good investment opportunity. The problem is those assumptions, those unknowns, or rather known unknowns, some of them we've discussed right here, they're not easy to quantify, and they're not easy in particular to relate to the limited data that is available and will be available in the future as we start to track the performance of our existing and also the failed portfolios, companies that we've had and have. And the problem with that is, firstly, if we don't do it, well, then we don't know how different decisions, how we can allocate our money. Should we take this new potential investment or not? How does that affect our uncertainties? Or maybe putting it also another way around is, what is the uncertainty about the future expectations given we make one decision or another? That is the real problem that we don't know really how to solve today. Because that's all based on either an intuition that we have, or at best, essentially, we make an educated single number guess in a spreadsheet like this. And we hope that that is a good representation, a seemingly good representation. The problem is that that is rarely the case. All of these different parameters and variables, essentially, and concepts we've talked about, they all of those kind of uncertainties will affect each other and compound through various different calculations that ultimately is going to lead to a kind of metric number that makes it more apparent whether a decision is good or bad. But those uncertainties makes that final image very obtuse, and it's very difficult to intuitively reason about how these uncertainties plays with each other. and how they affect one another in the final outcome. So it is highly likely that if we did use uncertainties, we would actually make a different decision, invest our money differently than we would by just using these point estimates. And more to the point, we can't update those kind of uncertainties to be more consistent with the data that's available, in which case we will very much so become more and more accurate, if you like to say it that way, about our expectations of these uncertainties by using the data that's available. So we need to solve these two problems to make better decisions about how to invest our money. Because there's too much to consider here, realistically. But it is the best thing we can do now, and the way of using the current set of intuitions and expertise is still going to make these predictions very likely to be much better than some other person just making a completely random guess for all of these numbers that drives our analysis. But it's still only perhaps a half or first order, whereas there is so much more here that can actually be leveraged and understood by doing it. And that's really the ultimate exercise for this use case. And just to go back to talk about some of the costs that comes from these problems, one is, again, we have inflation. The money depreciates in value as the dollar value goes down. And we have a potential opportunity cost, which is if we don't use our reserve, well, then we can't make that money work for us appropriately. And then I've not even added here the fact that we'll be able to actually also look at different possibilities of investment opportunities to decide which of them might be the better ones. And perhaps you should wait. So there's a lot we could dive into here. And we'll see later on that there's going to be layers to these complexities and what we can build. And we'll start with the sort of simpler one of them at first. So again, the crux of the issue, going back to how VCs sort of work today, is that, for instance, the investment to reserve ratio, which is just the how much money do we need to invest and how much do you want to hold in reserve, is in many cases at least a sort of one size fits all like policy, which is obviously not true. That would depend on a particular startup. We can't just expect that we would need double the amount of money for our next follow-on investment. Of course, we could make it a policy that we won't invest more, but then we are completely ignoring, similar to what we'll look at now, how much more value can the money generate for the business as well. So perhaps it's not a great idea either to constrain the money that is needed. And so we might at that point in time consider perhaps we should actually spend some more money if we need to cover a discrepancy where they couldn't raise that elsewhere. So we can start to paint a much better picture about this. We'll see. Then there's the timing of the investment, or our investments or our portfolio's future investment rounds, which is generally unaccounted for. Again, there is a plan, but it's not something that is continuously adjusted in our beliefs about when the next round will be needed as early as possible, which again affects our strategy for how we want to invest our money. And finally, we may not account for the duration of an investment. And what we mean by that here is similarly, how long will it be until we might exit so that we essentially get all the money back again. So I should probably add that here just to make it easier to talk about. Right? That is when might we expect money to come back to the fund, perhaps to reinvest, or at least as a reserve, or as reserve, or as reserve. So this seems quite reasonable that we might want to consider this as well as we plan out. Because if we were to plan out what's going to happen into the future, if we might expect that some of our portfolio companies being sold, or we might exit them within the next year, will that frees up resources? Potentially, assuming we are able to reinvest those resources. There may or may not be situations where VCs are under some sort of set of constraints that disallow profitable investments to be reinvested, simply to minimize risk. But if we can, well, we should consider it when we start to plan. So to go through how we might consider building some of these models, I've written here 5 different ones, and these are not exhaustive. This is just ways we could go about it, but it also illustrates ways that one can continuously build on top of one model and then another. So in particular, we'll start off with now today to infer the investment to the reserve ratio from historical reserve needs. So we're going to be simulating some of this to also keep VCs anonymous, etc. But we could look at later on actual VCs. But for now, we'll build the skeleton, and we'll see how we can build essentially almost like a template that can then be applied on different VCs afterwards. And you can see where different VCs might consider making individual changes to the model as appropriate. So for instance, we might assume for simplicity that there are different categories, startup categories that have the different demand reserve needs, that demand different reserve needs. We could also consider the reserve needs to be driven essentially by cash on hand. So we, in this case, would directly project out the performance in terms of both sales and expenses, and how much money it remains in the bank, basically to determine that when you are a certain amount of months away from zero, the next investment round will begin. So this is where we can start to add time constraints and time considerations to our forecasting and our strategy and decision making. So we might consider that the burn rate could depend again on the category, and it implicitly would then determine also future valuations. So now we can use this as well to make assessments into which category is better than others. And before we think, oh, well, if one category is expected to generate the most return on expectation, well, a way you would make a strategy decision today is you would obviously put all your money into that one basket. The problem is you might very well have that one category has higher expected value, higher expected return, but has far greater uncertainty and risk about that. And so depending on your risk profile, that will drastically change your investment strategy, and you might be a balance between the two in some way. And just to sort of draw out what I mean by that. Now I think I know what the problem here is also. Anyway. So again, just like before, if we have A here and we've got company B here, we might have return, dollar return, and I didn't mean return up here, that's actually the other way around, but this here is, let's say, a sort of a probability, the chance that you get one return or another. So that's what we mean by this. This is the chance that you receive one return. And over here, you've got the dollar value. And we have the same thing over here for B. And we have percentages. So we can draw this loosely. So let's say, for instance, this one generates 1,000. Maybe not thousands, that might be a little too little. We want that to be more. But let's say this one returns here at this point on expectation, say 1 million. So you can see I'm also getting slightly this much. This might generate 1 million, and it looks sort of like this. So you can see here there is 1 million goes down there, meaning that this point here is the most likely, so that is quite likely to generate about $1 million in its return. But what if then B, on the other hand, here, so I'm going to make this actually more egregious in the example. So let's just say it is very, very, very likely here that it's just exactly on top of 1 million. So down here we might have that we've got 0 there. But now let's say instead that B, let's say has, let's just say it's got 10 million up here. And you still have 0 there. But it looks more like this. And it's kind of on purpose here also that I'm drawing this in a way that is not particularly smooth, because this may look something like this in terms of how likely different events are. But we might say that the mean value here roughly is a little bit skewed here to the left in some way, maybe a bit more. I'm eyeballing here, but for the sake of the argument, it explains the problem. So you can see here, this number here is somehow significantly greater, right? It might be 8 million perhaps. So greater than the 1 million. So what that means is simply that on expectation, it would seem as if B is better, right? But the variance is much, much greater. So we can see that, right? There's this whole blob down here, which put a lot of essentially chance that we will lose money by investing in B. So while it can perform much better, it might actually fail entirely. And even in terms of its performance, there's a good chance it will be even still be less than the 8 million and also less than the 1 million. It could also be bigger though. But the question is, what is our risk tolerance? We might be more comfortable with investing here in A, where it's much more likely that we'll make a profit, and it's $1 million in profit. But let's say we have certain expenses coming, in which case we can't risk potential losing this money because we need it. So we might rather invest in A, because at least we can be very, very confident that there's a very good chance that we will in fact at least make our 1 million in returns, as opposed to B, which could come out much, much worse. And this is not an insignificant chance. So that is just to illustrate that knowing the uncertainties is actually where we can start to think about how is our risk tolerance aligned with the decision we make. Because what we do today is essentially ignoring the width here. We don't use the width. Today, if you just plug in this one number everywhere, essentially what will come out is going to be something like this. It's just going to be, we predict this to be this number, like that, and we predict A to generate this number, and we would obviously say that B is the better choice. Well, obviously, but the problem is we should also know that there's actually a very good chance that B does not succeed, and the problem with that is we don't know. We never had the information that told us anything about how likely it is that we would actually end up down here, and it matters. That's the crux of the issue. So that is why starting to think about these uncertainty is very much a good idea, and how we just saw that it can very much change the decision-making processes. So this was very easy to illustrate. Okay, now the next one we can consider as a model in a higher level as well is we could consider the company's performance to determine future round valuation terms. So we could model the investment's expenses, revenue, headcount more specifically, and we can use a DCF, so discounted cash flow model, to estimate future round valuations. So essentially elaborating on 2, we're making it more detailed. Now we'll be adding more information and uncertainties again. 4, here we go. 4, we might be looking at multiple promising investment opportunities, not just one. And we might only have funds available for a subset of investments. So we might like all of them, but we simply don't have the money available to invest in all of them. So now we're really getting into constraint territory. The question is, how might we want to, how should we spread out our funds amongst them? And which one of them should we choose? And this is where we really have, again, another trade-off like the one we showed just before. And in this case, it's a matter of, we might be better off, and it depends on what our model would predict, but you can imagine a situation where the system will tell us that, well, there is a chance that we are better off choosing a bigger set of less profitable companies that is offered to us today, but the aggregation of them in our prediction is going to lead to a more likely combined profit, as opposed to choosing a couple of fewer investments, which each of them might give big returns, but there's also much more volatility in how they're going to perform. So these are difficult problems that we need something that is more sophisticated, essentially, you would say, than what the tools allow us to do today. Because there's nothing out there that really allows us to dive into these kinds of problems and build out these sort of models that can actually answer some of these questions. And finally, I need to stop clicking this every single time, and I just did it again. And finally, we might want to quantify the possibility of a new, better investment opportunity coming sometimes in the future. So that requires us, again, to start to model things such as, what is the frequency at which investment companies will start to reach out to us? And what is the potential, that is the value or the expected prospect potential of such companies when they appear? And again, similarly, this will impact whether an investment should be made today, or maybe we should wait altogether. So you can imagine a case where perhaps after some time that we as a VC have operated, we have some information that might suggest that, and some knowledge about the market, that when you combine it, again, how is not quite clear. We'll see how you could do it, but you can imagine that perhaps we could combine a few data points with some expectations to answer questions such as, or perhaps get an answer such as, Q2 seem to have sort of more better options to invest in, while, and by that I mean, again, maybe more volatile, but again, unicorn-like potential investment opportunities, whereas Q1 has fewer but much more consistent options for us to invest in. So again, depending on what we want to do at the point in time in Q1, we may or may not want to wait till Q2, even though there are plenty of decent options, but we would rather wait, and hopefully we'll see what comes along in Q2. We may be wrong. The problem with all this is we may always be wrong, but at least if we can do all these things, we'll have it all quantified, and we can make the decision that is needed on a basis that will tell us what the risk is that we're running when we make all these different decisions. So it's not much different than playing the lottery, essentially, which again makes perfect sense if you think about it. Okay, so let's go and see how we might build this first model, the one that is simpler. I'm gonna go back here now and pick 2 as we start to dive into this. This is what we wanted to see, but we need to add some of these things, additional models that I forgot. All right, so again, we're just going to look at the reserve ratio at first to see what money is available as we look at a new investment opportunity that will come in the future. So we'll start with that as our as the first entry point. And I've drawn this out with nice little arrows here. So basically we'll look at defining a set of company categories. We might look at 2, maybe 3. We'll just start with 2. It's not that hard to add up more. And then we'll look at, let's say we might consider modeling out with a sort of average reserve ratio that depends on what company category we're looking at. And similarly, we will look at what is the amount of capital that each capital needs when a round is announced. So we might consider the seed round and a Series A round. And then we also might consider what is the average return within that category. And you'll see in a second here that we've not accounted for the fact that they might also fail, so we'll add this in a second. Now, each portfolio, again, doesn't follow the average reserve ratio, right? This is some sort of hierarchy of a descriptor across the board for the category in total, not just for the ones we are looking at. So somehow, if we know what this number is, we can use this to say something about what the specific reserve ratio that is needed is for each individual different portfolio company in our portfolio. And the same is true for the particular capital that is needed when we invest now and later. And just as the same, again, it is a matter of what is the return that is also specific to each individual company. But if we know how much capital we need, if we know the reserve ratio, we know the specific reserve ratio, we also know how much reserve we need to allocate to a potential investment. So once we have all this, we can start to look at between two different new options for which we will apply the same logic here. We can decide which one of these are we able to invest in, and given the particular return, how much money will that investment give us? So this is going to be a trade-off, and I don't know how this is going to turn out. I haven't built it yet, but we can immediately see at least that there is a set of problems here, namely that the one that provides a bigger return might also require a greater reserve need. So the question is, if given how much we already have invested, there might be a certain risk that in order to get a good return, it is dependent on being able to follow on in the future. So the average needed capital here will contain also the including, so I'm going to add this actually, so this is a good point. Oops. Including future rounds. Yes, sir. I'll make this a little bit smaller so we can actually see this. Oh, really? There we go. And I'm going to have to take a break here in a second, but we'll be back right after. There we go. There we are. So you can see, given the, so again, to go back here. So given the specific return, we can look at how much reserve is needed, just to reiterate. But whether or not what the risk is, if we're able to do it, might be something we should consider. So again, on expectation, one of these might be much better than the other, but it may very well turn out that the chance of that actually of failing and losing all the money and perhaps not being able to make that return is in fact bounded by the fact that we might be running low on reserve cash here. So that's a gamble, right? Do we risk it? So you can imagine that if we fail to make the next investment round, follow-on round, well, then the expected return is going to be much, much, much greater. Smaller, of course. And so that is a failure mode in which we simply won't make it, whereas the other option may very well, I guess we'll see if that's the case, may very well prove to be such that even if we miss a future round, we're still highly likely to make a big enough return on our investment. Or maybe it's a matter of the fact that, excuse me, that the investment required for the second round is simply just much, much smaller. So these are all things that we could consider and play around with, and that is what we'll start to do now. Okay, so I will take a short, brief break here. That has been a plenty long introduction, but hopefully this was somewhat informative, and I will also make a shortened version in the future. I mean, it really would be more fun if people were here to debate and discuss, so I could practice this, but that is what it is. Let's see here now. Be right. All right, we are now back again. I'm just gonna make sure I can keep track here on this other machine. There we go. Perfect. I can hear myself as well. Which is exactly perfect. Excuse me. All right. So, where were we? We were about ready now to get started with building our model. Now, I think one of the last things we talked about beforehand is in order for us to make a reasonable, I think, amongst other things, a starting model here as the entry point. If we just did it like this, we'd sort of forget the known possibility that an investment that we make simply will fail. And we have aggregated information about that from just the general investment market of VCs. I think it's about maybe 30% that succeed or fail. Forget which order it is. I have the resources for that. I just forget exactly where it is, but we can see that in a little bit, I suppose. But we should probably account for that in our model here. So I will do that while we're here. This is also, by the way, how I generally start when I build my model. Is I like to draw it out like this, where I have all the different kinds of variables and how they connect to other variables, so how they might affect these other, now it's going to be essentially numbers that we're going to use for our analysis. But this is going to be the hit rate. And of course, the hit rate is going to, there we go. The hit rate is naturally going to be determined by here. The category of which a startup belongs. And similarly, then the hit rate, if we know that, is going to determine the average return that we'll see. So here is also going to be a decision of how much data, or not data, but how much money we're going to invest. So I haven't added the levers here as well. There will be additional sort of inputs in various points of this graphical model, as it's called. But essentially, this is the sort of high level sort of starting point that kind of helps us map out what goes where. Now, one thing to consider is that eventually, since we're going to be doing this and essentially make this prediction for every single individual company in our portfolio, but also the ones that will not be in our portfolio, but outside the portfolio that we are considering to invest into, and as well as the previous investments that may not have turned out as much in our favor. That means we want to condition on exactly all of these kind of numbers. So we want to condition, as it's called, on what we have observed historically and what we will observe in the future. We want to add them here as nodes that we can say, well, now I want to know, well, if 5 of our, let's say, previous investments exited, for all of them, what was the return for each of them that we observed here? And then how does that affect everything else in the entire graph? Including also knowing the specific amount of capital needed for those companies, the specific then reserve ratio that we were calculating and predicting, and so on and so forth. And that is where we get to that second problem that we listed before. The first one is, how do we add uncertainties to this picture itself so that we can better understand the trade-offs between risk and reward, essentially. But the next one is, how do we make this adaptive? Like, what this adaptive decision-making under uncertainty capability that we want, that's what makes this possible. And that is what our system allows us to do. And I'll tell you, if you were to do this by hand or mathematically otherwise, that would not be a particularly fun exercise. That is a very complicated attempt that most likely will fail, and something that I would never endeavor on my own either. It is what we need, some other tool that allows us to do that for us automatically. That is the whole sense and the purpose of this, which is why we also consider it a branch of artificial intelligence, what we have built here with Evara. But let's get started. I think we should start with some of our assumptions and the parameters that we know, and then we'll start to go back and forth as we might need more constraints or uncertainties to be referenced. So let's start here. We can probably just, for the sake of argument, let's just make this, yeah, let's take that and make this nice and well formatted. So this is a little bit harder. This is not so interesting, but if you care to know, what I'm doing is I'm simply right-clicking, going down to the format cells, then under alignment, I here choose the horizontal text alignment and choose this center across selection. That just means that you retain the cell-like column structure rather than merging the cells, which can sometimes have some weird side effects depending on how you reference cells, etc. So I like to do it this way, because that means we can just write here in the first cell, and it will automatically fill out all the cells here that we've marked. I'm just going to write this as assumptions, so you can see this is exactly what I was alluding to. Call that assumptions. We're going to make it a little bit bigger, and now we're going to give it a different color, because I like to do these sort of things a little bit. Here we go. We can make this perhaps nice and blue. Yeah. All right. So there'll be a lot of assumptions here that we'll probably start to write, and some of them will be nicely laid out. We can write anything here. There's no restrictions to how we do it. And then we'll see what the Evara tool does in a little bit. So firstly here, what we'll say is let's just say, oh right, we're zoomed in, that's why it looks so much bigger than I'm used to. We would consider this to be named, this is the assumption. And its value. Okay, so that doesn't work anymore. Interesting. I can't basically use my arrows to move around the spreadsheet, but I guess that doesn't matter too much, I suppose. Thick bottom, there we go. We put that in the center like that. Okay, so this here is font size. Let's start with this. That's actually annoying that I can't use. Why is that actually? Anyway, so font size, how big it is, our font. Now let us see here. Perhaps this is, there we go. So let's make this bold and font size. Now here, this is what one might typically do as we start to add assumptions or constraints. Okay. So we'll give this a assumption slash constraint, because it will be a constraint, of course. And we will then here use it and ask if it is an assumption or if it is a constraint. Is assumption is constraint. And the neat thing is, if we go to data, we can add a checkbox and a checkbox. And then we'll make sure that this thing is nicely formatted here as well, and that we spread this one out. There we go. So the font size, that's a constraint. So it means there's no uncertainty about this, essentially, which makes it a little bit easy. This is the perfect starting point. So let's suppose that perhaps we want to make this easy to say that we have 1 million here. So there's $1 million available to us in the fund. We're gonna just use it. There we go. All right. That just means that we don't have, by whatever we do, no matter what we do, rather, there is no way for us to spend, or rather invest more than the $100 million. Okay, so this is going to be decomposed into money we can allocate and money that we can also put in reserve. Now, for now, at this point, let's ignore how long this might last. And I think if we just look at this here for a second, this is what I'm using later. Not so important. But essentially, and I think I'm just going to go quickly check here something. Da, da, da. Just finding another thing I've already added a little bit. To some of it. Let's just see here. I will check this out. Huh. Actually, I haven't. That's pretty neat, actually. All right. Perfect. So, here we go. So another assumption or constraint that we would need to consider that is perhaps more global. That means more than one thing will reference these assumptions. Would be the average we're actually going to put this a different place now that I think about it. So that's the other main thing. So now we want to say how many different kinds of portfolio strategies, categories rather, are there. So call it startup categories. And we'll make it slightly easier. Category 1. And this one will just do something like that. Let's just say there are, wow, Excel is very clever. Very clever. And these are all gonna be constant as well. So there might be multiple different ones. And as a matter of fact, I don't think we want them here either. Do that. I'm gonna do this. And we are gonna transpose it. Yep. Mm-hmm. So we're going to take these and we're going to move this around. I'm going to add that down here. There. So we have multiple assumptions essentially. I think actually what we'll do is we'll take this and just extrapolate this out. Perfect. Here we'll do startup category. Startup category here. And perhaps we also want that actually to do like this. But we don't, for now anyway, want to have any borders now. So we'll have startup category in this way. And for that, I'm actually gonna cheat a bit and just find some, rather a couple that could be interesting to consider. There we go. Of which some of them are more obvious than others. There we go. Okay. Industry. So we'll just take a couple of a few ones here. So we might have something like advanced manufacturing. Other constants. We'll add that too. We'll add this here to that. Categories. Categories. There we are. So we'll have advanced manufacturing. And we might have, let's say, let's just do machine learning and AI, because why not, after all. And then we can do hardware. And let's just keep it like this for now, actually. Yep, that doesn't seem too bad. We'll add this underneath that as well. All these here goes to the center. There we go. That is good. Okay. That's perfect. So in fact, we will use this and place that down there also. And these will have its formats cleared so that we can probably use this, which is also great. And we'll actually add this on top and below. There we are. Okay. So we've got startup categories. Those are now those ones. Now we'll have what we mentioned back here. So these were average reserve, average needed capital, average return. So here you can write average reserve ratio. And we will have average capital needed and average, or rather, let's just say, let's call this expected. That might be a slightly better way of doing this. And this didn't quite thing, and this is really annoying that the thing doesn't work. So call this expected reserve ratio, expected capital needed, and the expected return. Right. So this is again a simplified version. In that we are not going deep into defining what the return would be, for instance, for each portfolio company by building it up from the ground up. Right? We could very much have defined it such that, how shall I put that? We could very well have defined it such that we predict and model out the sales performance and other key metric performances for each of these kind of companies within these also different categories, and use that instead to drive, for instance, the value that's generated given a certain amount of money that's invested into the business and how they're currently operating. So we would add that. So because of that thing, we're going to add here a little, let's just see here. I'm not going to use that. Well, I could for now, I suppose. Oh, that is pretty good. It'll be good to search for later, but I'm going to put it over here for now. If I find it, I'll share it. So for now, we could consider giving it a little identifier so that we know this is a point which could be elaborated on later. So let's see here. Those are called essence font. Kidoki. Blah, blah, blah. These are called accents. That's not what I want. Dagger. There we are. So we will use this and put it in here. And now what we can do is, well, not that, I suppose. Now, if you want to insert that as a symbol, which we do. But I also want to, decimal, no, hex, yeah, hex Unicode, we like that. Special characters, these are very special. Okay, I'll just do that instead. And well, I would have preferred to elevate it. And this one is not it. Anyway. Superscript in Excel. Let's see. Yes. I remember. We can format the text. Superscript. There we go. There we have it. And we will also give it a light color of sorts. Let's see. Don't we have a nicely looking color here? I don't want any one of those. Yeah, we'll keep it like this here for now. We'll do make this bold though. And perhaps red. There we are. Expected return. So now I'm gonna actually at this point make up some numbers. And while this may seem, how should I say this? Not entirely random. It does, of course, seem like, why am I not using something that is real? Well, this is because this is actually where, very much so, the specific knowledge from a VC is what would be used here. So this actually illustrates exactly how, again, even with a system that we'll show here with ours, it is not this sort of black box system that is sort of a one-size-fit-all approach that has, let's say, some sort of model that has been trained as a neural network, maybe like a large language model-esque sort of thing, which is just using some aggregated random some data with a model that may or may not be at all applicable or be able to do what we want to do here. And we're just claiming that somehow this has been trained magically to work in the particular use case. No, it is much, much more, how should I say that, sophisticated than that. Namely that the expert and knowledge and the experience-based intuition that a VC would have can be leveraged much better with Evara and our system that we've created and developed. But it starts with being able to write it down, those intuitions, and write down those uncertainties and assumptions. So this is, at this point, we're doing that first bit, which is being able to quantify these uncertainties. So this is where we would have expertise, in fact. So how does one do that? Well, what we would need to start with is to define what we think advanced manufacturing, on average. Just suppose that I looked across all sorts of startups within the advanced manufacturers, right? And to make it a little bit more specific, let's say it is the seed startup category. Startup categories. So this is the reserve ratio. We'll do this here. Seed stage. And similarly, we'll do for this one. It's a seed stage. And expected return seed stage as well. So now we would have to make some sort of educated guess, and we can decompose this essentially further down. So it might be the expected reserve ratio of startups at the seed stage in the geographic locations that this VC that we are care about. So of course there's no fundamentally right way right here to do this where you have to choose one and go out and calculate everything. In fact, it is very much okay to use either a bit of historical data you might have lying around, look at a bit of your databases, etc., to see what might be the reserve ratio needed for startups that fits the seed stage or the other profile that the VC that we are considering being or pretending to be would invest in. So in this case, let's say the ratio is, let's say advanced manufacturing is one of those where we can get away with less money in the beginning for prototyping, just a bit less. But if you want to scale it up, we might need to build something like a factory. So the second round is going to be much bigger. So let's say that roughly, if an advanced manufacturing startup needs, let's say, just $1 million, we might expect that the next round they need to raise 10 million so that they can kind of really grow. And advanced manufacturing might mean big machines and so on and so forth. So let's say that might be around an 8 ratio. So we might need to do the same to keep our investment ratio. Now, and this is the interesting part. This investment ratio is perhaps already slightly too simplified. So I'm going to add, in fact, this one here as well. Okay. I'm going to do that first, and we're going to add this here, and we're going to make it into a superscript. So, in fact, this is not even necessary at this point. We already started to do this. So what I wanted to do, in fact, is flip these two around. Start here, like so. So the capital that is needed. So the second time, so here we've got the capital needed seed. Then here we've got capital needed Series A. And so why does this matter? Well, because it may seem, see if you agree, to make more sense to have the reserve needed based off of how much capital is in fact, see here, going to be needed the second time around. So you can see here, do it like this. And we do multiplied by this number. There we go. So this is 0 for now. So there will be some multiplying factor of however much capital was needed initially. Now, we'll return to this here in a second, because first we will say how much is expected to be needed in advanced manufacturing. So now, let's say we expect there to be needing, what is needed is this number. So $5 million is what is necessary at the second time. At the first time, to get started at seed. That is perhaps a little bit too big. Let's just do 3 to begin with. So we might need 3. And then for the second time around, what we need is a lot more to really start to scale when we raise our Series A. But this is where we have our first issue, right? is that we know that we're not going to be able to exactly say that this is the average. And we may or may not be able to decompose it so that we're doing a proper average estimate for the subgroup that we care about. Like maybe in the United States, we might need slightly more to keep expect capital needs to be higher than some other place in the world. So we can't look at all investments across the board, and it may not be the easiest data to get a hold of. Maybe it is, maybe it isn't. Maybe we can get something that is somewhat diffuse and somewhat unclear exactly how broadly this average is calculated. So we want to add some flexibility to this number. So again, we think it's around 3 million that's needed, but perhaps it's plus minus 5. So how do you write something like that? Because we can't just do plus minus like this, say 500,000, maybe a million, right? We can't just do this. That doesn't work. It doesn't do anything. So how would we do that? Well, luckily, that is the first step of Evara, because this is the first problem that we will need to address, which is defining all these uncertainties, assumptions we have, so that we can allow them to propagate through our entire system. And how we do it is simply just by adding the uncertainty like so. And now we are starting to interact with the interface of Evara. So you can see I just clicked the thing up here, up top. And then I clicked over here, add uncertainty right there. And that made this form pop up. And so here we can choose different types of uncertainties. So you can see this one is called around, which fits the language that I just used. And it has an expected value. So that is perfect. We expect there to be $3 million. But we also know, or rather said, that it's going to be about 500,000. Like so. Or perhaps double that. So maybe we're going to say, yeah, we're going to say 500,000. Maybe a million. Let's do a million. Plus minus a million. So you can see now what we're observing down here is what this looks like. And right now, I just need to be sure that this does work. It just needs to be properly framed, but that is fine. But basically, what we're seeing down here is that there is a set of possibilities, scenarios that could be generated. That is, in this case, a scenario for the expected capital that is needed, or the average rather. And so what you see here is that the chance that it's going to be greater than 315,000, which is a little bit small, I will have to admit. So perhaps we'll do it like so. There we go. So I just changed this to 250,000 because I realized this is the average. So we're not that unsure about the average itself. And perhaps a better way of calculating this is actually to take the average expected number and multiply this instead with a percentage that we are unsure. So that could be perhaps we are maybe 10% uncertain, which works actually like this. So you can write it in exactly this way. So now you can see indeed the average or the expected value, which is also in this case the most likely value, fits perfectly right here in the center. But there's an equal chance that it's going to be below, which is in this case roughly about 300,000, which is about right here. So there's most of the chances is between this point here and this point up there, roughly. So plus minus 300,000 to the 3 million is where all of our possibilities are going to be most likely to most likely explain the expected capital that is needed. So we can add this. We'll look at this uncertainty here in a second. So we can add that. So that was basically it. You can see we actually returning here the expected value still, which is great, but you'll also notice up top here, you can see up here, that the formula is not just a single number. It's actually an Evara dot around. So this is one of the macros that comes and ships with Evara. So that means this actually behaves in a special way. It's a special macro that will do some magic later on to be able to help us make a decision on how to invest in the future. But this allows us to reference this number elsewhere. And in particular, you can see we've now addressed this first point right here. Now, the next one is how much would we need at Series A at that point in time on average. So this is going to be in the similar fashion as before, where we will actually be calculating the expected capital needed as a factor multiplied by the amount needed during the seed stage. So I will just say that is whenever a Series A is raised in advanced manufacturing, it's going to be a fixed multiple of whatever was raised in the former round. Again, on average. But again, that is going to be an uncertain value. And in particular, it's probably going to be more uncertain what this multiplier is. Now, of course, we could have done this in a slightly different way, where we also go and we look at what is the Series A advanced manufacturing. But in our case, we are kind of considering the Series A needed, again, subject to the ones now that we are investing in. So at this point, we've already started to consider the fact that we would say, what do we expect a business or a startup that we have invested in already that they would need when they will have to raise their next round, which is a bit more specific than just looking at everything completely, totally on aggregate. So now we're making a guess about sort of our selection process, which is much, much harder to find, again, any data for. So we're going to make an educated guess. So just similar to before, we'll add the uncertainty. We already have the 8 multiplied by the reference point, which is the expected capital needed. Now, what we're going to be writing here now is we're simply going to say that this could be really, instead of 8, we might just say that it should be a bit less. So maybe 8 is the topmost point. And so what we're going to do is we're going to reference the same thing here and say it's 4 and then multiplied by, let's say the uncertainty isn't 4 times, but it is by adding essentially the uncertainty on the factor. We could say it could be plus minus 2. And then we multiply simply by the E10 number here to keep it. So now you can see that, and especially, I don't think I can actually make this bigger, but you can see here now that we expect the amount of investment needs for the second round to be somewhere most likely between 2 times whatever was needed in the first round, all the way up to about 8 times. So you can see that looks like this, assuming that B10 is just 3 million, of course. But this is essentially all we would need to do with this. We can add that as well. So we can see, okay, next time they raise money, we expect that to be about $12 billion. So now we can look at what is the expected reserve ratio. So how we're going to do this is quite similar to above, but now we have to make a sort of sense about how much of, how should we say that? How much of the new amount needed to be raised we want to take on, which is essentially independent from the capital needed here. Now, of course, we should mention that it will probably be useful, since this is a pretty important point, is that given pro rata rates, we're certainly not, very unlikely rather, to have a clause in our contract that stipulates that we can demand in any way to be able to buy in or follow on the next round of investments by more than the relative amount that we have already owned. So whatever our position is from an ownership percentage perspective, we're not entitled to be able to buy more than that to protect our position, unless we're offered. So in reality, we might want to use that here and say what, again, average ratio, or fraction rather, of the money that's needed to be raised do we take on. So in this case, what we would potentially say is maybe we like to take a bigger chunk for the first time. So we could do this and say that. So we can say position size. So we'll call this here our SAVC position size, or fraction rather. And again, this is just to again reiterate, this is just a way to do it. You could write this in any other way you would like. This is a quick first pass. It's taking longer as I'm also trying to explain it, and now it is turning out to be too late, so I should probably go to bed soon, to be honest. But there is so much flexibility here at this point. So in this case, as a VC, our percentage fraction, let's just say that we expect this to be somewhere around, now we're going to do Evara. You can see here we have a lot more to choose from. But let's say it's going to be around, and here we'll use a clever alternative. So actually, I'm just going to show this. This is a good point to do this. So we're going to show this like this. So you can see here are some of the options you can choose from through the scroll bar. And perhaps what we'll do is we will say that our position is going to be between two numbers, but otherwise fairly uniformly. But let's say we have a min-max position that we want to take in any investments that we do, relative, by the way, to the amount that is needed. So here again is another point. We might actually use this to say we should probably define this maybe even in terms of what is the valuation of the business, and then from that decide what is the position fraction that we want to take. But for now, let's just say we want to define the fraction of the investment needed to be raised and assume we're happy with the valuation just always. Those two things can be mapped back and forth, but this depends on what sort of logic and physical reasoning that someone who is building this model wants to place on top of each of these assumptions. But here we might just say we don't want to go lower than 20%. We want to take at least that. We also don't really want to take more than 40. And now you can see we have this nice little box, and that says exactly that, namely that we'll not go lower and we won't go higher. And that is a general rule. So we'll take that and we will make this into a percentage. So this is actually a constraint. Think about it. So now we've then, again, just very simply, we've added a nice constraint here. Okay, so this is our expected investment fraction. That we might want to back reference. So ultimately, we might not want to have one of these. We might have this to be different for every single one, but this could again be the expected investment fraction. Okay. This is the expected our expected investment fraction that can come out as this. That is about 30%. And we'll probably honestly do that every single place. Maybe we'll do it slightly differently, actually, now that I'm thinking about it. So we'll just add these all these places here. So perhaps, you know, maybe we're getting a bit tired of all the hype. So we want to invest in ML and AI, but we don't want to take too big of a chunk of position there. Again, there might be certain responsibilities that comes along with that. So we will slightly limit the position that we'll take here. So this might be maybe as low as 10%, and we won't do more than 25%. So we want someone else to take the big lead on these within this category. And in hardware, maybe we're really starting to be more interested in hardware, actually. So here we're willing to go all the way up to 55%, or let's just say 50%. And we won't take less than 25 on average. Okay, so what's going to happen here actually is going to reference this as well again for each individual investments that we do. So there's going to be more randomness around this whenever we look at the exact amount that we're going to take, but we'll still bound it by these numbers as well. So it's not going to be greater than or less than, perhaps except for a minor little deviation. But again, we can choose to do that. That is really what that means. All right. Now that is out, actually. That's perfect. So now in this case, since this is the chunk, this is the expected investment fraction we'll take, we'll say that the investment ratio, right, is going to be the ratio between these two. Right, very simple. So it doesn't actually matter. Well, you could also calculate it, but it turns out to be the same, so that's fine to do, and we can do that here in a second. But the ratio here is, of course, how much this is. This is how much more money we'll do, so we say this is divided by that. You see that comes out to be 4. And of course, just to verify, if we want to consider it directly in relation to the fraction that we take on, that would be this multiplied by that, divided by this, also multiplied by that. And that turns out to be, well, it will be the same once we do the following. Like so. There we go. So you can see that turns out to be exactly the same. Now, the reason why it might be interesting to not just do it like this is because we don't know if we want to follow on to exactly the same fraction that we invested in the first place. And what I mean by that is, even though this is still an expectation, meaning that the exact amount that we are investing is also, in that regard, an expectation. So we can't just use this directly. The idea is to say that the expected amount, perhaps, that we would follow on is really what we should consider to determine the reserve ratio. And what that logic is going to be may not be something we want to spend too much time and energy to think about, but perhaps it's not unreasonable to think that we might want to downvote it a little bit, right? And we do this in such a way that if we were to actually invest with a bigger fraction later on when we look at individual portfolios, companies, then this is, again, it's just an average. So we've already accounted for sort of at that point in time the increase, and that's what we will do, is that the actual reserve that is needed is now predicting concretely how much money is needed and concretely how much of a fraction we have. And the only uncertainty then that is left really, well, the two others are still uncertainties, but the only other thing that we can't consider as a real prediction is, well, actually, what I'm saying, I really need to go to bed now. But so what we really need to do then is also to predict exactly the ratio that we would want to reinvest in the second round. And we'll just reference this, of course, ratio because of that. Essentially. Perfect. All right. So let us do it in that way instead. So perhaps this one we'll never actually observe, right? So we won't observe these directly. And that is also why I realized I wanted to perhaps change this here ever so slightly. Let's see. So instead of this, we're just going to change this in a little bit. We're just going to multiply by that. Now we're going to say that the factors that we have are these, just like that. And so this proved my point before. The expected value comes in perfectly like so. So this is then 4 plus minus 2 in the factor. Now I actually want to make it such that it is well, maybe not exactly heavy-tailed, per se, but we might here perhaps want to make it slightly bigger. 4.5, I think is nice. And then we're going to have to actually, we're going to add a max around this, because the around, if you noticed, could actually be negative. That's by design. Around doesn't have a bound on it. Not yet. There are other assumptions we could use that will have bounds on them, but this is just, it's such a low likelihood in this particular case that for the sake of staying a bit more consistent and squeezing everything up a little bit, we will say that this certainly can't be less than, let's say, certainly can't be less than 0, but in fact, let's just make it even more simple that we do not expect that we're going to invest. Obviously, it's not going to be less. That's going to be impossible, essentially. So it has to be greater than 1.5. Okay. So basically, we're saying with this, we guarantee that it is greater than 1.25. And we could, in fact, just say this has to be greater than 0. That makes it a little bit nicer. In fact, because then we don't squeeze too much up, and then we just add 1.5 to it. And move this back to 4. And you will have to excuse me here. Wow, my sneeze actually made it. That's hilarious. I thought I paused it earlier, but I didn't. Okay. All right, so the reserve ratio is like this. Now, again, we don't expect that to actually be the case. What we'll do is rather we'll say, well, we now want to consider the ratio, how much more money we need, as a multiplier. So it's going to be these two, right? So we're going to say how much of the capital needed that we took on expectation. And then we're going to do the following. We're going to say, well, it's not going to be 30%. It's going to might be slightly less than that. So what we're going to do is going to reference this. Like so. But then we're going to add another uncertainty around that. And here we're going to do another between. Like so. And what we're going to do is we're going to say it's not going to be greater than whatever that is on expectation, but it could be smaller than that. So we're going to say it's going to be whatever that number is, and then we're going to multiply it by something that could be a little bit less. So we might say, well, we generally want to stay on. Okay. So by that account, we'll do it like this. So we could say we might want to go all the way down to, let's say, we expect that we will do this by about 60%. Okay, maybe 70%. But we're going to add a very large certainty around it. Multiply. And so now we're going to say, well, it's going to be, you know, between any of these numbers. So I'm trying to consider, what I'm thinking about here is, how do we want this to look like? And perhaps we should try and draw this. That might be just nice to do for the sake of our sanity. And that thing lost its connection, so we can open it up here again. There we go. All right. So perhaps, remember we said this here was 30, and if we click on that, we can see that it was 20 to 40. I click this thing here right now. So if we want to consider the investment fraction, which was 20 to 40 right here. Right, so we can kind of draw this here. That was a nice square, which means it's 0 out here. Now, what we might want to do with this is instead to say, well, perhaps what we want to do is to take that still here at the 20 mark and have this be 0. But we kind of want it to sort of like flatten out a bit like this, right? Like 40 perhaps. So that it looks sort of like this. And what we're saying is just that, yes, we want to stay around there, but we kind of expect that on expectation, we're going to be sort of skewed towards maybe that lower bound that we would otherwise be comfortable with, simply because we might want to make room for others, etc. So generally, again, right, that doesn't mean there isn't outliers. It kind of depends. We might want to stay on, but sort of on average, this is perhaps what we might expect to happen. But you might be in a different, believe it differently, right? You might say, well, Maybe it should be more like this instead, sort of like the other way around, as opposed to what I drew originally. And I'm a little confused because it's not drawn or connected. Ah, it is battling a little bit. It is struggling. Which makes sense. That it is struggling, and I'm also in the middle of it. So I'm gonna, no one saw that, so we're gonna pretend that that didn't happen. So one thing we could use. Okay, here we go. There we go. Okay, so just to recap, let's say the investment fraction here was 20% to 40%. Then we can draw this out like this. So this is sort of the figure which shows the spread of the possibilities of these investment fractions that we might expect to see. They're all equally likely, but in this bound, 20 to 40. Now what I said here is the black one is I say, well, I might think that there is a slightly better chance that when we do our second round, we sort of skew ourselves toward that lower bound, 20. So I want to draw something that is kind of favoring that direction there a bit. But then I drew this red one here to say, well, you might believe the opposite, that many of these investments are actually generally believed to be very, very good. And we like to maintain as much of our position as possible also in the next round. And so we want to skew this upward towards what we're comfortable with so that we maintain that position. That is completely, again, another point here where this is very much unique and up to the individual, both VC and their policies, but perhaps even all the way down to the general partner, etc., to sort of decide what makes sense here. So these are trends that I wouldn't be able to decide on, and certainly I wouldn't be able to look this up anywhere. This is very unique and very individual to each VC. So this is where, again, really the specific knowledge and assumptions about the investment strategies can really be expressed. And this would be incredibly powerful, because this is why, for instance, how you built this, even if you use the same template, your analysis and your results will be different from another VC that uses otherwise the exact same template or starting point or ideas, simply because even something as simple as that for just a single uncertainty or assumption can have profoundly different impacts to the analysis, simply by this change of shape here in how we think one scenario is more or less likely. All right, well, that's, I think, enough of that explanation. There we go. Although, I think I might actually save this. I need it tomorrow. See. Oh, doesn't matter. It doesn't save that long. Perfect. Anyway, so how do we do that? You might ask. Well, the first thing we can do to get that shape right is what we can show here is something that looks a lot like it as an uncertainty. If you go back up here, we're gonna click it. Does it pop up? Where is it? I think we have reached a point in time now where, okay, it's still okay. So there's different rounds. Now, it turns out the decline sort of matches that shape we just thought about, or I just drew, right? It starts high and then it goes down. This is mirrored here. It starts high. So it starts high and then it goes down like that, like this. That was what we saw. Decline is exactly that. So you can see here, I'm just going to put it as a random number. You can see this has this exact kind of shape that we're sort of looking for. But then again, it starts with 0, so it's not exactly that, but we'll get to how we might manipulate this here in a second. But firstly, very briefly, what we should know about this decline is that its expected value that comes out of this can be expressed by saying 1 divided by this expected value, like so. And so, for instance, if I want the scenario to be 5 on expectation, I'll do 1 divided by 5. You can see here, 5 is roughly here, and then you might say, well, it's not symmetric. How is the expected value? Well, expectations and symmetries are not necessarily coinciding, or rather, the most likely number, for example. So the around one is such an uncertainty for which it is true that the expected value is the center point and it's symmetric around that point. Decline, it's not so. What we should consider here is that it's the expected value, meaning that since the tail here is very, very long for very large values, it means that there needs to be much bigger chance that the scenario, the possible value that's generated that we could conceivably put here, as we're imagining in it and making the assumptions about it, more of that will have to be less than the expected value, because there's only so many possibilities in terms of their values that could be generated. So for instance, there's a very good chance that it's very close to 0, but that adds very little to the expectation, whereas 40 is very large but very unlikely, but that trade-off means that 5 is going to be somewhere in between. That's just how that works. So we can also do this with percentages. So we might say that the way of drawing that out is that I think we will be kind of on expectation here, roughly end up at about 60%. No, let's actually maybe say 70%, like so. So you can see here now on expectation is 70%. Now the problem is, of course, it grows greater than 1. So then the question is, how do we fix that problem? Well, we can simply clamp it, which is quite useful. So you can see here in the function up top, I'll simply add the minimum value, right, between these two. And I'm actually going to do another trick first also, which is we also know it can't be lower than 20%. I'm going to add that first. So now I have added 20%. And then I'm going to say, well, it cannot be greater than the 40%. Right. So ideally, we might have these sort of numbers hard-coded reference somewhere else, because now if I change the logic in this cell, this one is essentially referencing that same like interpretation, physical interpretation. But I'm just hard coding it here for now. But to keep track of things, it might be a good idea to keep these numbers explicitly and verbose somewhere in the spreadsheet. But now we can add that. And we can see here now that, beautiful as it is, here it is 40 on expectation. And that makes sense, obviously. And that is because we forgot to, sorry about that, multiply this by this number. There we go. There we are. So right now, I want to make sure that we do this right. I've multiplied it in the wrong place. It obviously happens in here. So now you can see that what has happened is that it cannot be, and I wanted to reference this one here as well. So what we're sort of saying is that we can't make it bigger than whatever this expected value is. We can't go above that. So that is the max here. We're also saying at the same time that we're going to hit some sort of probability here, like 70% of whatever this is. But then we're going to add 20% to it. And then you might ask, well, why is that? Well, that is simply because, and we should probably make this 50 for that reason, so that when we add the 20, we're actually squeezing it back up again. So we're bumping it down and then bumping it back up again. So you can see it is absolutely perfectly 30%. So this might be somewhat a lot to digest the way I simply spoke about it. But basically, in case you wonder, if we take the decline, remember its expected value is 1 divided. Is it 1 divided by whatever is in here? So that means this number here is in fact the mean. So this is 50%. So that means on expectation, this should come out as 50%, which should be very much so 15, as we can see. Now, we can also see that oh, interesting. Right, so it can't be more than that. And this says on expectation. So we take this by 50%. So, this is just me being silly about this. So what we of course want to do is to say that this has to be some sort of threshold. Yeah. Okay. So I'm going to show this to you right here again. It's just sort of silly. So this here is then 40% minus 20%, right? So this, what this is this is the delta. So this is B11. There we go. This is perfect. It should be obviously 25. It's the center point should be right between the lower bound, which was 20, and whatever is sampled here, which is 30 on expectation. So you'd expect this one to come out similarly. That we're simply saying take the 50% mark of the difference, right? So if you've got this was sampled to be 30 and this here was 20, so the midpoint here will be 25, right? So this is the expected fraction that is generated. This is the lower bound, and the center point is then this one, 25. So the way we did that is we simply sort of scale everything down so that we find that the delta delta between the two is, right, is in this case 10 in this example, but generally it will be just b1 minus 20, right? So b1 minus lower bound, which is, if we replace these numbers, that would mean it is 30 minus 20. So that gives us 10%. That is what we want to do on expectation. So see here, we've got it here. Here we go. So, and then we say we want to be at the halfway point, right? So we can just change the halfway point, but then we say this is equal to then 50% halfway point. So we can define now where we want to lie on this difference metric. That turns out to just be 5. And then we just add back the lower bound so that we squeeze this back up again. So we're just transforming everything. And then we say, again, it cannot be greater than, so we choose the smallest number between whatever comes out of this, as well as this number here, because we can't be greater than that. expected fraction. So we should not do this. We should call this here bound also, because this is also the upper bound. So we're simply just referencing upper bounds, etc., moving things around slightly. So it's actually not that complicated. I'm just getting really tired to also explain it properly. But that is how we do this. And I should mention, this is not as hard as it seems, of course. And then the other thing is, although these numbers are all constant right now, once we run the system, we will actually consider those scenarios. So we do need to reference them appropriately. So why it seems like we can just maybe, why bother with all of this? It's because, remember, B11 is not a constant number. This thing is actually a random number, right? It's an assumption. We don't know what it is. We've made a guess about it. But what Evara allows us to do is that these guesses essentially become alive. Meaning that when we run the system soon through Evara within Excel, these numbers will start to be able to dynamically adapt and adjust both to data, but also simply how all these uncertainties start to manipulate each other and affect each other. So if we hardcode everything, we would obviously lose the Evara functionality. So the way to think about this is simply that just reference each cell, thinking and assuming that we don't really know exactly what the value is. This is just a possibility. And this is just the expected possibility. So now we're going to add this, and we're going to put this in here, and we're going to multiply that like so. There we are. Perfect. So this is right now the ratio on expectation. I'm going to leave this here as well. Now, just to show exactly what I meant here in this a second ago, is that so far we've just imputed all of these different numbers. Now, these numbers are all expectations. We will want to here now to show that what I mean by this not being this static. These are actually dynamic numbers in reality. What you'll see up here is that you have this thing here, we call it show dynamic scenarios. And if I click this, you'll notice that these things they just changed. And so I'm just gonna, again, nicely, I'm gonna make this much more nicely to look at, formatted. We're just gonna see like to second decimal. We wanna keep these around, so that's perfect. The way that these are already formatted, but you will see that now it says show default scenario, whereas the default scenario is that expected scenario for all of these cells. But what just happened here is that we sampled, which is what it's called, right? We generated one possible scenario everywhere, meaning we first made a scenario for this number, expected capital needed. Then we made a scenario for the expected investment fraction. These two don't depend on each other, so these are just generated separately. But then we also generated this expected capital needed for series A. Now, this thing depends, as we can see up here, right? This depends on B10. So this uses the sample value here, and then on top of that, it uses all these arounds to then generate its own dependent scenario, which turns out to be this. And we can see it just calculated the whole thing again. We'll do this again and again. Now, this is the exact same thing we do for the expected reserve ratio, because this thing depends on all three. So now you can see, just like we did there, when it recomputes and it generates a new sample, these all change. So whenever I click next here, you can see the numbers, they will just keep changing and changing and changing and changing. And that is very much by design. Now, what is also very interesting is that we can also use it to debug, of course. So for instance, you can see this number right here made the grave mistake. Now, that we forgot to multiply these things. So this is, I also debugged, so you can see this shouldn't be less than 1, of course. So this here number 10, right, is multiplied by the fraction. Otherwise it's not. Boom, there we go, 5. Otherwise it looks very weird. So now we can see that these things are all happening. So this is the ratio we would need to reserve, given that we want to follow along with this on expectation. Now, later we will reference all these, of course, individually for each investment, because these are all the expectations. We can see we've already made this quite complicated. And all of these assumptions are fairly reasonable, arguably, at least given the approach that I'm taking here. But this would actually be a useful way of going about this problem, even to this point in time. The next question is, how do I start using data? We'll get to that later. But already at this point, it becomes quite apparent that these things are not easy to sort of juggle around in our heads. And it's completely infeasible to generate what ifs. But because everything depends on everything. And so this explodes exponentially, and it gets worse because all these numbers here, they're all continuous, right? There's no gap. It's not a couple of different individual possibilities. There are an infinite number of possibilities, and they can be quite wide. So we can't just necessarily consider best worst case scenario, because it's not always clear exactly how the best worst case scenario propagates, because one best case, assume best case, maybe there is an inverse, like 1 divided by or something somewhere, so that smaller turns out to then maybe be better in how they relate to each other, so that what we think is the worst case could actually be counteracted to be a bit better somewhere else. And so we really just want something that can keep track of all this for us instead directly, and allow us to essentially explore all possibilities in one go. And that's essentially what we do here. And to see what I mean by that, instead of looking at individual scenarios, what we can do up here is that we can click this run button. And what run does is that it does the analysis, the one I just described, where we explore everything in one go. And so if I click this, what pops up is this form here, this progress bar, that generates all possible scenarios. And I'm going to zoom in here now. And so what we'll see is that we've generated this sort of nicely looking, maybe it looks a bit like the round, maybe it's a bit more square, triangular in shape. Could be that it seems a little bit less bell shaped, maybe a bit more triangular shaped. And I certainly would not have been able to come up with this shape and know what this looked like by, if we go back here, simply reasoning about what these three, how these four relate to one another. Right? I'd have to do the math, but it was actually, this is much easier to do just by making this sort of physical interpretation of how they relate to each other. It's many times easier than me trying to draw this out or do a couple of what ifs like scenarios. This was much faster and more easy. And we're going to be able to just take this and essentially just drag this out like this in a second as well. And then we've immediately covered all of the categories and so on and so forth. So things get, once you get accustomed to how this works, much more fast, and you'll be quite efficient in basically no time. But just to return to this particular number, remember, as you can see here, it says this is the prediction for the cell B13. We go back here, there was the ratio. So now you can see 4.5 is this particular ratio we will look at, and we can scroll through now this in all the possibilities that have been generated that we can explore individually, right? And we can see how all these particular individual scenarios and their values relate to each other. And you'll notice as I'm scrolling through this, we go back to the scenario plot here at the bottom, you'll see that there's this red bar. So that means this scenario that we just saw here, these values here, that corresponds to the location of this scroller, that directly translate into this location here. That means that this scenario belongs to this bin. So roughly there is I can't quite see the height exactly, but there might be at around, oh, it says here, like close to 7% that we lie roughly here within around this 3.15 mark. of what this ratio would be on expectation. Again, this is our prior assumptions as a starting point. But in terms of summary statistics, this might be a little bit nicer to consider. Besides looking just at the shape, you can see up here at the top, what it says is that the mean value, the expected value here is, as we saw before, is 4.5 with about 1.17 standard deviation. So that means we would expect at the beginning of all of this that the reserve ratio we would have to consider for this category, given all of our assumptions, how all of this affects each other, on average, that we would sort of look at is going to be somewhere between 3.3 to 5.7. And then that's just the average. So it's going to change from that as well when we get to the individual portfolios. But that's essentially the crux of this, right? So we can see that. So we've already gotten our first point. Now, of course, this is not particularly useful immediately because we want to be able to use this to make like calculations like downstream. But it illustrates how we have that. This is how easy it is to sort of write out a couple of just few uncertainties, have them relate in a physical, interpretable manner, and we can immediately explore every single one of these assumptions and everything else in the entire spreadsheet that could depend on them, and see and analyze the results through the figure, firstly, such as this, and the summary statistics. And later we'll see how we can actually make more concrete decisions about what we should do, and not just for reporting purposes. But that will probably be either this weekend or later, early next week, probably this weekend, since I have to go to bed now. But that's going to be quite exciting. So hopefully you will all join again. Well, I'm saying all, that's crazy. It's silly because there's no one around. So I'll be back on in maybe tomorrow, actually. If not tomorrow, then I will be back on over the weekend, maybe Saturday or Sunday. And we'll stick around because we will be doing these kind of models many times going forward. This is VC's investment. We have for stock investments as well. We've already made a video about how to choose premium pricing and insure for car insurances. There'll be more models coming that way as well. So if you're an actuary, for actuaries for that matter, there are so many personal budgeted like use cases that I'm considering wanting to build. And I would love to hear some of your feedback. If you would like to see something specifically as well. Because there's so much interesting stuff that can be done with this. But obviously we haven't quite gotten to the final point here, so you may not quite be interested sort of just yet. But anyway, thank you so much. And as we say, it's all about turning those uncertainties into opportunities.